Your age pension may already be changing, and you might not even know it yet. Every year, thousands of Australian retirees assume their pension payment is fixed, locked in, safe from any surprises, only to open their MyGov account and find the numbers have shifted without warning. If you are receiving the age pension or you are getting close to applying for it, this single update could affect how much money lands in your bank account every fortnight. Stay with me, because by the end of this video you will know exactly what has changed, why it happened, and what you personally need to check before the next payment cycle rolls around. Welcome back to Aussie Benefit, the channel dedicated to helping everyday Australians understand their pensions, payments, and entitlements without the confusing government jargon. If this is your first time here, consider hitting that subscribe button, because we publish regular updates just like this one, breaking down exactly what Centrelink and Services Australia are doing with your money. And if you find this video helpful, please give it a like. It genuinely helps this channel reach more retirees who need this information. Today we are talking about the 2026 Age Pension Update, a set of changes that many pensioners have not fully registered yet, even though these adjustments directly affect income support payments, asset thresholds, and how much you can earn before your pension gets reduced. Whether you are already on the pension, receiving a part pension, or planning your retirement in the next few years, this information is essential. So let's get into exactly what is happening. The age pension in Australia is reviewed regularly, and payments are indexed twice a year, typically in March and September, to help keep pace with the cost of living. This means the base rate of your pension can rise, but it also means the surrounding rules, the income test, the assets test, and the deeming rates used to calculate your payment can shift at the same time. Many pensioners only pay attention to the headline figure, the actual dollar amount they receive, and completely overlook the thresholds sitting underneath it. Those thresholds are just as important, because if your assets or income creep above a certain point, even by a small amount, your pension can be reduced automatically, sometimes without a clear notification explaining why. One of the biggest areas to watch in 2026 is the assets test. Services Australia sets limits on how much you can own outside of your primary home and still qualify for either a full or part pension. These limits are adjusted periodically, and if your superannuation balance, investment property, savings, or other assets have grown, even through normal market performance rather than any deliberate saving, you could unknowingly cross into a new bracket. This is particularly common for retirees whose superannuation is invested in growth assets, because a strong year in the share market can lift your balance and reduce your pension entitlement at the same time, even though you never touch the account. The income test works alongside the assets test, and Centrelink uses whichever test results in the lower payment for you. This is where deeming rates come into play. Deeming is the method the government uses to estimate the income you are earning from your financial assets, savings accounts, term deposits, and investments, regardless of what you are actually earning in real terms. If deeming rates are adjusted, and they have been a point of ongoing discussion, the amount Centrelink assumes you are earning changes too, which can directly affect your fortnightly pension amount, even if your bank account interest has not moved at all. Another area that often catches retirees off guard is the work bonus. If you are still doing some part-time work in retirement, whether that is casual shifts, consulting, or seasonal work, the work bonus allows you to earn a certain amount before it affects your pension. This threshold and the way and used amounts accumulate can be updated, and pensioners who assume the rules from a previous year still apply may end up with an unexpected reduction in their payment after reporting their income. It is also worth mentioning that eligibility age requirements and residency rules are reviewed periodically, so if you are approaching pension age, it is worth double-checking the current qualifying age rather than relying on outdated information from a few years back. Even a small shift in policy can change your expected start date for receiving payments. So what should you actually do with this information? First, log into your MyGov account and check your current income and assets details on file with Centrelink. Make sure the figures match your real financial position, because outdated information is one of the most common reasons pensioners are overpaid, underpaid, or hit with a debt notice later on. Second, review the latest published thresholds directly on the Services Australia website. Since these figures are updated